A 4,996 STI level is a headline-grabbing vanity metric that pays exactly $0 toward your retirement. The forensic truth is found in debt issuance pricing and the breach of gearing ceilings. Today we are auditing 4 yield traps hiding behind the index rally to protect your SRS portfolio. I have been watching these balance sheets for a while. The numbers that finally made me sit up were the gearing figures. The index lies to your pocket. The STI approaching 5,000 is a psychological milestone and it is distracting you from structural risk. You might be holding assets where management cheers for growth while the balance sheet quietly screams for air. Your SRS portfolio is not a tool for index chasing. It is a sanctuary, and that requires the 4.7% hurdle to remain sacred. It is time to look at the actual numbers driving this market. Ignore the headline noise. It pays you absolutely nothing. The STI closed at 4,996.95. Resistance is effectively shattered, but the forensic divergence remains extreme. The 6-month T-bill sits at 1.46%, well below our 3.2% forensic floor. The 3-month SORA is fluctuating around 1.10%. With the STI approaching 5,000, yield compression risk is high, but our floor holds regardless of index euphoria. Now let us move to the first forensic target. Keppel Infrastructure Trust. The 7.36% yield is the forensic bait. The 56.1% gearing and the 1.3 times interest coverage ratio are the hidden hook. At 53.5 Singapore cents, the current yield looks highly attractive on the surface. But the leverage and coverage figures tell a much darker story about how that yield is being sustained. The raw facts. Keppel Infrastructure Trust is proposing to price 200 million Singapore dollars in notes due 2033 at 2.8% per annum. Total debt sits at 3.59 billion Singapore dollars against assets of 6.40 billion Singapore dollars. The yield clears the 4.7% hurdle. But that is where the green stops. 56.1% gearing completely obliterates the 35% ceiling. Compare that to Netlink NBN Trust running at 26.2%. Keppel Infrastructure Trust is a massive structural outlier. The forward risk is straightforward. Bringing on new debt at 2.8% into a balance sheet already running at 56.1% gearing leaves zero room for adverse rate movement. That places the already thin interest coverage ratio under immense pressure. For a 60-year-old retiree in Jurong managing an SRS drawdown, this yield is not a gift. It is the market pricing in structural balance sheet risk. High yield without debt clarity is a red flag, not a sanctuary signal. On a day when the STI is touching 5,000 and investors are hunting for income, this yield will attract a lot of attention, which is exactly when forensic discipline matters most. A 56.1% gearing ratio means more than half of the asset base is funded by debt. The interest coverage ratio sitting at approximately 1.3 times tells me that operating income barely covers the interest bill. Netlink NBN Trust runs its infrastructure book at 26.2% gearing. That difference is not a footnote. It is the entire argument. The yield is real. The risk attached to it is equally real. Strict watchlist trigger, not a commitment. Next, OUE REIT. Gearing has cleared the ceiling here, but the interest coverage ratio fails the test. The yield has ticked up to 6.11%, and at 2.1 times interest coverage, the recovery narrative runs out of road. We are seeing 8.4% year-over-year net property income growth. That sounds impressive on paper, but we have to look past the surface growth to see how the balance sheet actually functions under pressure. The raw fact is this. Net property income rose 8.4% to 57.6 million Singapore dollars. Total debt sits at 1.86 billion Singapore dollars against total assets of 5.57 billion Singapore dollars. The yield clears the hurdle, and gearing at 33.3% passes the 35% ceiling. That is a genuine positive compared to Keppel REIT breaching the limit at 37.6%. But at 2.1 times, the interest coverage ratio fails the 4 times fortress balance sheet screen comprehensively. Any hospitality revenue softness would compress net property income and push the interest coverage ratio further toward the 2.0 times floor. That makes distribution sustainability a live question. Geopolitical uncertainty and the wait-and-see effect on convention bookings are live risks to that growth trajectory. For a 45-year-old HDB owner in Punggol using dividends as a salary supplement, the gearing is under control but the interest coverage is not. Wait for evidence that interest coverage is trending toward 3 times before committing any new capital. The 8.4% net property income growth is the kind of number that gets highlighted in broker notes. My forensic read is more measured. Gearing at 33.3% is a genuine positive in a sector where peers are already over the line. But the fundamental problem is covering the interest bill with such limited room to spare. Net property income growth improves the picture. Hospitality revenue is heavily sensitive to macro sentiment. The gearing story is better than expected. The interest coverage story is not. Watchlist trigger firmly. Now a confirmed trap. Suntec REIT. At a 4.69% yield, Suntec has officially fallen below the forensic hurdle while operationally stalling. At a price of 1.50 Singapore dollars, the yield fails the required test. 37.3% gearing breaches our 35% ceiling. This is what happens when heavy leverage catches up to operational softness in a challenging environment. Convention business bookings have slowed significantly due to geopolitical uncertainty. Total debt sits at 4.06 billion Singapore dollars against total assets of 10.88 billion Singapore dollars. The yield is 1 basis point short of the hurdle. In this framework, there are no partial passes. For a 65-year-old in Clementi drawing CPF life payouts, this is a confirmed yield trap. Neither the income nor the balance sheet clears the necessary forensic screens. Sustained softness in convention bookings would seriously pressure net property income and organically reduce distribution per unit. And because gearing is already above the ceiling, management has no debt capacity left to bridge an income gap. The directional risk is strictly downward on both yield and coverage. There is no forensic case for deploying any new capital here. The final confirmed yield trap. Leong Asia. Corporate expansion via acquisition cannot mask a 1.53% yield that is a total failure for income investors. Even with a 90.7 million Singapore dollar acquisition cost, the 31.2% debt-to-equity ratio does not fix the fundamental dividend problem. A loud growth narrative cannot substitute for actual cash landing in your pocket every quarter. The company acquired Yong Tai Loong for 90.7 million Singapore dollars in cash. Total debt sits at 805.6 million Singapore dollars against equity of 2.58 billion Singapore dollars. The 1.53% yield is a comprehensive failure against the hurdle and the floor. There is no forensic case for a dividend-focused portfolio here whatsoever. BRC Asia yields 3.02%, also failing the hurdle, but delivering nearly double the income of Leong Asia. For a 55-year-old PMAT in Tampines, this is a strategic neutral, a pure growth play. Zero sanctuary for your SRS or CPF income. Now for a piece of good news. Bumitama Agri stands out as a clear sanctuary. At 1.92 Singapore dollars, the 6.03% yield clears the hurdle with meaningful headroom. Energy price spikes are providing a massive geopolitical commodity hedge in a market where most income options are compressing. For a 50-year-old in Toa Payoh, this is a confirmed sanctuary real yield, while other balance sheets struggle to stay afloat. Looking at the broader market, BRC Asia is verifying at a 3.02% yield. That is a massive downgrade from prior estimates near 5.8%. Broad institutional optimism is driving the index upward, but a rising tide does not lift all forensic boats. This sector-wide yield compression makes our 4.7% hurdle much harder to clear across the board. The forensic floor does not move. The minimum yield hurdle remains 4.7%, the 3.2% forensic floor plus 150 basis points of mandatory risk premium. Even with the T-bill at 1.46% and SORA around 1.10%, the floor exists to ensure your sanctuary assets can withstand a return to long-term average interest rates. Not just today's levels, the floor does not move with the index. The window is already open, and the window closes extremely fast. The difference between a confirmed sanctuary and a dangerous yield trap is regularly decided in a single trading session. By the time this analysis reaches a free subscriber, the critical entry window has often already closed. This is exactly why Iggy's elite investors exist. If you want zero-day forensic breakdowns and the full red zone watchlist when the numbers still matter, you need to stop being the exit liquidity for the market and start being the analyst. For less than a kopi and kaya toast set at Raffles Place, you get the institutional-grade cheat sheets the exact moment the setup is live and actionable. The bottom line is forensically clear. Keppel Infrastructure Trust is a structural red flag and a firm watchlist trigger due to its massive 56.1% gearing. OUE REIT safely clears gearing but fails interest coverage. Fragile watchlist trigger. Suntec REIT is a confirmed yield trap with two massive strikes. Leong Asia provides only forensic noise at 1.53%. Only Bumitama Agri stands as a clear sanctuary at 6.03% with a meaningful geopolitical tailwind. The only truth that matters is the real yield that lands in your pocket. The divergence between the Bedok retiree still holding Suntec and the Woodlands investor position in Bumitama has rarely been wider. The STI hitting 4,996 is a distraction from the operational reality of these underlying balance sheets. Ignore the vanity metrics, focus on structural health. That is how you protect your retirement. To summarize the forensic scorecard, Keppel Infrastructure Trust passes on yield but fails the ceiling and interest coverage. OUE REIT passes on yield and gearing but fails interest coverage. Suntec REIT fails both yield and gearing. Leong Asia fails on yield entirely. Only Bumitama Agri passes as a confirmed sanctuary. A vital reminder on the stress test buffer. The 3.2% forensic floor holds steady regardless of market euphoria. To ensure your assets survive long-term average rates, not just today's conditions. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The red flags were always there. Protect your capital and beat the 7-day embargo window by joining Iggy's elite investors through the link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.